Many economists have talked about a potential recession in 2023. But what evidence do we have that a recession is coming? A recession is a significant, widespread, and prolonged downturn in economic activity. Some experts believe we're in a recession if we have 2 consecutive quarters of negative gross domestic product growth. However, this is not the official definition of how economists evaluate an economic cycle state. Other factors, such as the state of the labor market, consumer spending, and industrial production, need to be considered to determine how bad things are going. Recessions are caused by a chain of economic events, such as a financial crisis, a war, or a global crisis. When a recession hits, all market players, from the smallest to the largest, are shaken by the consequences. Only those who are prepared will be able to survive the recession that will come in 2023. On June 8, 2022, the NBER announced that the unprecedented magnitude of the decline in employment and production and its broad reach across the entire economy warrants the designation of this episode as a recession. The 2022 recession began in the first quarter of the year when the economy contracted dramatically. Because of COVID-19, everyone was forced to stay at home for months. As a result, the economy slowed down, ultimately bringing hundreds of countries to the brink of collapse. Since no one could leave their homes, thousands of businesses had to close their doors, lay off their employees, and declare bankruptcy. As time passed, people were dying in hospitals or unable to pay their rent. As a result, savings began to dry up quickly, leading to a drop in consumption. In some countries, such as China, the population is still locked up. Since domestic vaccines are ineffective and China refuses to import vaccines, COVID-19 remains a recurring problem. And in other parts of the world, very few measures were taken. Consequently, the spread of the virus led to the hospitalization of thousands of professionals. Shortly after, even the least restrictive countries saw their productive capacity fall drastically. The world was in crisis, and only a few could make ends meet. For some analysts, the recession of 2020 was far worse than the Great Depression. That's why governments tried to inject more money into the economy to prevent its collapse. But unfortunately, this measure, which generated temporary relief, has caused devastating consequences that could bring us closer to facing a new recession in 2023. As you may know, the United States is facing the highest inflation in its 40-year history, and most countries in the world have a similar problem because of supply chain disruptions combined with loose monetary and fiscal policy. It's not news that prices are higher than ever. Gasoline, food, and utility prices have all risen recently. All these measures have triggered unprecedented inflation that no one seems to be able to control. But what exactly is inflation? Inflation is the economic process that occurs when there's a mismatch between supply and demand. If there's no balance, the price of goods and services rises dramatically. The direct consequence of inflation is that citizens lose purchasing power, so we're able to buy fewer goods and services with the money we earn. One of the most frequent questions that financial channels receive is why money cannot be printed and distributed among the population. Everyone knows that printing banknotes generates inflation, but does not understand precisely why. Simply put, money is a commodity in the economy, which people demand to purchase other goods and services. Therefore, if the Fed increases the money supply overnight without an increase in demand, it loses its value. In other words, inflation occurs when there's too much money for too few goods. Thus, a country's wealth is not defined by its capacity to print banknotes, but by its productive capacity. No one would need to work if it were as simple as printing banknotes to create wealth. But unfortunately, that is not how economics works. Imagine every person had a machine to print money. In that dream world, you would only need to press a button to print $1 million. After creating $1 million, you want to go to a dealership and use that same $1 million to buy a car. The problem is, that dealership owner is no longer interested in your money. What happened? If the dealership owner could also print $1 million, he wouldn't be interested in selling you one of his cars because it would be more difficult for him to create a car than to get money. Therefore, he would probably look for something more valuable in exchange for his vehicle to compensate for the time it has taken him to produce it. For example, he might want some farm animals to close the deal. Before we know it, our economy could end up reverting to the old barter system. As you can see, printing paper money is not the solution. It may generate temporary relief, but if the government does it for a prolonged period, the prices of goods end up rising. That's why shopping and going to the supermarket have become much more expensive in the last few years, turning our former lifestyle into a privilege. However, the inflation faced by the United States is not something that happened overnight. Since 1933, the US dollar has lost 92% of its domestic purchasing power. As a result, hundreds of thousands of families have been dragged into poverty, prompting the Fed to try to put a brake on it by raising interest rates. Throughout 2022, the Fed has met 6 times to raise interest rates to combat inflation and control price growth. But what is the purpose of interest rate increases? When you get a loan from the bank, for example, to buy a house, an interest rate is attached to that loan. This interest is the price you'll have to pay in exchange for borrowing money. However, banks also need to borrow money. So instead of borrowing directly from other banks, they usually turn to the Federal Reserve, the central bank of the United States. The Federal Reserve's primary function is to provide a safe and reliable financial system for the U.S. by maintaining deposit accounts for banks. As a result, when a bank needs to borrow money, they have to look to other banks with a surplus. The same logic can be applied to most of the world's banks. As with any loan, banks also have to pay an interest rate. The percentage that banks pay is known as the federal funds rate, which is set by the Federal Reserve. Increases in the federal funds rate influence all aspects of the economy. When you borrow money, the bank passes on the cost of the federal funds rate to your regular loans. In other words, if banks have to pay more, it will be more expensive for you to take out a loan. According to the theory, consumers spend less if it's more expensive to borrow money or use a credit card. And when spending decreases, demand decreases, causing everyday goods prices to fall. However, this is where all problems begin. The actions being taken by the Fed are the perfect formula for starting a recession. According to economists, the combination of higher borrowing costs, high inflation, and slower growth could lead to a crisis between 2023 and 2024. Since not everyone takes the time to educate themselves financially, the next recession will likely catch thousands of people by surprise who will not be able to survive the consequences. Recessions are usually characterized by a reduction in almost all economic variables, including investment, consumption, employment, corporate profits, and inflation. Only through a recession will the government be able to stabilize price increases and return money to its former value. The bad news is that recessions wreak havoc. Depending on its severity, a recession can be mild or abrupt. In the latter case, we would be referring to a crisis. For example, when many companies go bankrupt, they drag down employees and suppliers, causing employment to rise. And when a recession worsens, we call it a depression. As we debate what lies ahead, the U.S. economy has entered into something of a paradox. On the one hand, we have GDP growth slowing significantly, and on the other hand, employment growth is higher than usual. This paradox has led to companies being overpopulated with professionals with overly high salaries that cause production costs to be higher, especially in the technology sector. During the pandemic, many technology companies benefited from confinement. Since everyone started going online to buy products or surf the web, many firms had to hire more staff to serve all these new customers. But what do you think happened to all the employees these companies hired after the world returned to normal? As you can imagine, the owners of the tech companies were faced with a dilemma. Either they kept a staff they no longer needed, or they laid them off and compensated them. Either way, they ended up losing large sums of money. Sadly, only the companies that made staff cuts will survive the next crisis. Since COVID-19, about 1,506 technology companies have had to lay off employees. But recent studies show that the technology sector was not the only one hurt by the 2020 recession. While companies like Meta, Zoom, and Amazon found themselves amassing a fortune, most retail owners who couldn't bear to be down for so long also filed for bankruptcy. And only those businesses that managed to adapt to the technology and information age survived. According to CNN Business, the U.S. economy has added another 2.3 million jobs in the last 6 months, far exceeding any other 6-month period in the previous 20 years before the pandemic. As a result, the tight labor market we find ourselves in, coupled with rapid wage growth, has led to inflation being more entrenched than ever. Consequently, the U.S. Treasury Department initiated a rescue plan to save the economy. Unfortunately, the excessive printing of 2020 bills has caused the dollar to lose its value. If the Federal Reserve wants to prevent prices from going through the roof, a recession will likely become inevitable. But why does the world need to go into recession? If the government wants to get things right, the recession will be inevitable, no matter how optimistic our view of our market is. But if they decided to continue to camouflage the problem, the only policy measures that could make it stop would be to increase inflation, which would lead us to face a worse recession in the future. Nevertheless, we still have hope, because Federal Reserve Chairman Jerome Powell has decided that his top priority is to get us back to low inflation, no matter the cost. Unfortunately, recessions are never easy, but they're a necessary evil to have a healthy economy and get back to being able to pay for our own products. As fear and uncertainty mount, several Fed officials have come out to explain that ending anti-inflation efforts too soon could have worse consequences than avoiding an early recession. But if the government had done things right, we would never have faced this dilemma. Instead, many officials have used the COVID-19 pandemic as an excuse to keep printing money. But as a wise economist once said, inflation is simply theft from wage earners. Because of the government, individuals no longer expect prices to go down, but up. That is why most people prefer to spend rather than save to protect themselves from increases. Unfortunately, such a mentality has caused inflation to continue to accelerate. But what if the next recession cannot prevent prices from rising further? In that case, we are lost. Interest rate increases may not be enough to put a brake on global inflation to pre-pandemic levels. Unless supply disruptions and the labor market pressures abate, interest rate increases could leave the global inflation rate at around 5% by 2023, nearly double the pre-pandemic bi-weekly average. Even if most of us will live to see tomorrow, the consequences of the global economic slowdown could be devastating for emerging markets and developing economies. According to specialists, the global economy is now in its steepest downturn following a post-recession recovery since 1970. Even the world's largest economies, the United States, China, and the European region, have slowed abruptly. While living is becoming more complicated, consumer confidence continues to fall sharply. Despite all this bad news, some economists point out that there is a way to control inflation without triggering a global recession. However, it would require the collaboration of several economic players to make this work. To begin with, central banks must clearly communicate their policy decisions and safeguard their independence. In advanced economies, all central banks would need to be mindful of cross-border spillovers from tightening monetary policy. Meanwhile, emerging markets and developing economies should strengthen macro-prudential regulations and build foreign exchange reserves. The second requirement would be for authorities to carefully calibrate the withdrawal of financial support measures and be consistent with their monetary policy objectives. In fact, the share of countries that will tighten their fiscal policies next year is expected to reach the highest level recorded since the early 1990s. Policymakers must also establish credible medium-term fiscal plans and provide targeted relief to vulnerable households. And finally, the remaining policymakers will need to join the fight against inflation. Among the measures that should be taken, a study published by IBRD points to the need to reduce labor market constraints and price pressures and increase the global supply of commodities, including food and energy. If policymakers succeed in strengthening global trade networks and take all these measures forward, the recession could be avoided. But sadly, things can never be easily solved on our planet. One of the keys to stopping the impending global recession highlighted by this study is an international collaboration. But if you've been watching the news, you're probably aware of the conflict between Russia and Ukraine. With these two countries amid a bloody war that is tearing Ukraine apart, it seems unlikely that the world's governments, while going through their own problems, will be able to join forces. The war between Russia and Ukraine has created two major camps. On the one hand, that of the European and North American powers that support Ukraine, and on the other hand, the Eastern countries that have greater affinity with Russia. That is why the war is not an isolated event. If any country decided to interfere to tip the balance in favor of one side or the other, we could end up witnessing an unprecedented war, and the consequences would make the recession look like a joke compared to the loss of life and economic damage that would result from a full-scale international conflict. It is not news that the United States and Russia are not best friends. Since the origins of the Soviet Union, ideological differences between the two countries have repeatedly brought them into conflict. Even if some believe that the Ukrainian war is an isolated problem, the evidence shows that it could hamper our effects to avoid a recession. The European support for Ukraine has led Russia to stop supplying gas to Ukraine's allies. As a consequence, electricity costs in Europe have risen dramatically. Meanwhile, U.S. support for Ukraine has further strained relations between Russia and North America. So, it would not be unreasonable to say that Ukraine could become the excuse to start World War III. Because of the advancement of technology, a war between Russia, the United States, and the great powers of Europe could end up wiping humanity off the face of the earth. If Russia were to start a nuclear war, most countries would not survive the destruction caused. To make matters worse, Russia has a gigantic ally, China. So if the two countries were to join forces, there would be little we could do to confront their united troops. Unfortunately, periods of war are never good for the economy. Considering that the world's major powers are threatening to go to war and we're facing high inflation, it would not be an exaggeration to say that things are not looking good for our planet. As if this were not enough, rising inflation in the wake of the war has caused great concern in the markets. Combined with aggressive interest rate hikes, it's no wonder that stocks are plummeting. Even the cryptocurrency market has been hit hard due to all these phenomena. And the FTX scam that led to crypto assets like Bitcoin continuing to fall exacerbated the situation. As of today, the sharp declines caused by the pandemic have been reversed. Yet, the current macroeconomic situation has caused new problems and challenges. Nevertheless, experts point out that investors and retirees should not sell their stocks in a panic. After all, the loss only occurs when we sell our assets. As you can see, the dire economic situation we face today is not the result of a single factor. Instead, it's a multi-causal phenomenon that has put every economy in the world in check. Even if things don't look good, the goal of this documentary is not to scare you, but to help you be prepared. Although the recession is imminent, you should remember that the economy tends to have periods of growth and crisis that repeat endlessly. So it's nothing we haven't faced before. If we've survived the Black Death, the Great Depression, the dot-com bubble, the 2008 crisis, and the COVID-19 pandemic, we will be victorious against what lies ahead. The key is to stay informed and act before things happen. But what do you think? Is there any chance we'll not go into recession, or are we already doomed? We'll be reading you in the comments. See you soon.